Hello, everybody. At this time, we are talking about banker's acceptance or BE. A banker's acceptance is a negotiable piece of paper that functions like a post-dated check. A bank, rather than an account holder, guarantees the payment. Bankers' acceptance are also known as bills of exchange. They are used by companies as a relatively safe form of payment for large transactions. BAs can also be short-term debt instruments similar to US Treasury bills that trade at a discount to face value in the money market. And then, why are bankers' acceptances important? Bankers' acceptances are important because they provide a reliable, low risk form of financing for both buyers and sellers in international trade. By involving a bank as a guarantor, BAs reduce the credit risk associated with a transaction, as the bank's commitment to pay the amount due makes it a secure investment. This makes it particularly useful in situations where parties may not fully trust one another or where the buyer and seller are in different countries with different legal systems. Additionally, bankers' acceptances are used by banks and financial institutions as a form of liquid asset. They can be sold or discounted in the secondary market, providing liquidity for businesses and investors. This liquidity can help smooth cash flow, especially for companies engaged in international trade or those seeking short-term financing. And then, how does a banker's acceptance work? When a business issues a banker's acceptance, it works as a way for the company to pay for a specific purchase. This allows them to not have to borrow any money or receive financing to do so. On the flip side, the company that receives the banker's acceptance understands that it's a guaranteed form of payment. When this happens, the bank is required to pay the acceptance holder a specific amount of money by a certain date that gets set. They are often issued 90 days before the date of maturity. However, they can get issued anywhere from 1 to 180 days. And yet, when a banker's acceptance gets issued, it gets issued at a discount to its original face value. This ultimately means that they can get traded in a similar way to bonds in a secondary market. As well, the only downfall of cashing them early is the potential for loose interest that could have been earned. And then we move to advantages of bankers' acceptance. The first, more funds can be raised. Bankers' acceptance helps facilitate trade and commerce where it would have been difficult under normal circumstances. Hence, it helps companies conduct more business. At the same time, it also ensures that the bank's capital is not locked in these deals. The secondary market provides liquidity to the bank, which can continue using its capital to make more loans. And then the second advantage, liquid. The inclusion of a large third-party financial company means that a large number of parties are willing to hold the banker's acceptance. This increased liquidity, which results from the bank's endorsement, is what results in the creation of a money market security. And then the third advantage, lower cost of funding. Bankers' acceptance has a lower cost of funding for companies as compared to many other alternatives. In most cases, the cost of issuing a banker's acceptance is the same as taking a short-term loan. In a few cases, it may even be lower than taking a short-term loan. The end result is that the overall cost of funding is low, making these instruments more desirable. And then we move to characteristics of bankers' acceptance. The first, the banker's acceptance is issued against the party's creditworthiness. The bankers receives a commission for facilitating such trade. Thus, the bank's profit is involved in the successful execution of the contract. And then second, bankers' acceptance is known for its easy conversion from instrument to real hard money. In addition, it is said to have a higher liquidity since the amount is passed from the bank holder's account to the debt account at the time of the instrument's creation. Thus, there is confirmation of liquidity with lower risk. And then the third, the banker's acceptance is available only for customers with good credit history. Such customers are usually corporate entities with good credit history. Such creditworthiness is also linked to the investment in bonds. And then we move to the impact of bankers' acceptance on trade finance. The utilization of bankers' acceptance has a significant impact on the trade finance sector, offering a bond and blend of security, liquidity, and flexibility that is unmatched by other financial instruments. By allowing businesses to navigate the uncertainties of international trade, BAs contribute to the smooth operation of global supply chains and the growth of international commerce. Moreover, the legal framework surrounding bankers' acceptance provides a solid foundation for its use in trade finance, ensuring that parties can engage in transactions with confidence. And as global trade continues to evolve, the role of BAs in supporting commercial transactions is likely to expand, driven by their proven reliability and the ongoing development of legal and regulatory environments. In condition, right now, bankers' acceptance embodies the synergy between finance and commerce, serving as a key facilitator of global trade. I think it is enough. Thanks for watching.